Welcome to the Contrarian Capitalist. Welcome to Chart of the Month for May 2026. Delighted to be joined as per usual by Tom Bradshaw, author of the excellent Beyond the Headlines on Substack. Highly recommend you give that a like and a subscribe. Tom, how are you?
Very good, thank you, Rob. I'm really looking forward to going through another chart this month.
Absolutely. And just before we get started, three small bits of housekeeping. Number one, this video was recorded on Thursday, the 14th. I know you said 16th, I'm getting confused. Thursday, the 14th of May, 2026. It is about 2:15 Eastern Time, just as an FYI. Number two, none of this is to be constituted as investment or trading advice. We are not financial advisors. Number three, please do subscribe to both the Contrarian Capitalist and Tom Bradshaw on Substack. If you listen to this, go to the post that comes with this. There's a couple of buttons there to make your life easier. I should also point out, thank you for everyone to continuing to provide feedback. We've had some great feedback from the one we done in April, and I think a few of you said really good video, but let's try and keep it to 15 minutes. So that's what we're going to try and do today. Tom, again, you've got another excellent chart. We're going to be talking about AI bubbles and whether this bubble that we're seeing, whether it's the second biggest in 80 years. So bring that chart up and feel free to go through it.
Perfect. I'll just share. Is that up, Rob? Is that good?
Yeah, that is clear to me.
Right. So what we've got here is we've got the S&P 500 adjusted for corporate earnings. This is quarterly average prices we got on this chart. Now, this basically shows, if we look at these prior peaks, this shows where the S&P is currently trading. We are currently at the second highest level we've been in history, and this is adjusted for corporate earnings. Now, what's significant about this is that yes, a lot of people have said we're in a sort of corporate earnings boom, and that's absolutely correct. In fact, since the COVID-19 pandemic, we've seen corporate earnings rise 110% or 14% annualized. And normally corporate earnings grow around 7% annualized. So they've grown twice the rate they normally do. So that's absolutely correct. The unfortunate thing is that the S&P 500 has grown 131% or 16% annualized over this period. So what's really happened is, yes, fundamentals have improved, but the S&P 500 has kind of outrun them in many ways. It's kind of the market's ran ahead of itself. And particularly over the last few years, we've seen sort of the AI boom take hold. And as you can see here, what we've got is we've actually spent, the most significant thing about this chart is we've actually spent 7 years in what I call the death zone. And this is when the S&P 500 rises above 5,000 points, when it's adjusted for corporate earnings. And what's significant about this is that leading up to the dot-com bubble, we only spent 5 years in the death zone, so 2 years less. And leading up to the 1961 Nifty 50 peak, we spent 1 year in the death zone. So this bubble has gone on longer than any other that we've seen on this chart. And it's worth noting we're only 1,000 points below the dot-com peak. So we're getting very close to this level. Obviously, this data will be updated this quarter. I know the S&P currently is trading around 7,500 points. So if we continue on the vein that we're in at the moment, we could well find this quarter we're averaging between 7,500 points, which would take us a lot closer to this dot-com peak. And we're way above the peak in 1961. And it's worth noting the median of the S&P to corporate earnings, adjusted for corporate earnings, is 3,750 points, which is around
Wow.
3,000 points lower. And that does imply around a 45% drop if we were to go back to the median, which is a reset, a reset that we saw one in 2000, around a 50% drop in the S&P. We saw a 58% drop in 2008. So a 45% drop would be in this ballpark. And it's worth noting on this chart, we have, you know, following the 1961 peak, we fell much lower than the median
Mm.
by the late 70s, early 80s. And similarly in the dot-com bubble, we fell way below the median in after it crashed in between 2000 and 2002 and the subsequent 2008 crash as well. We fell back below the median. So it could be a lot more, but I mean, but the point is really where we sit today, we sit at very elevated levels. And I think the, I mean, obviously the market can go higher, but the risks are mounting the higher we go. And it is really, to be honest, to me, it's quite mind-blowing that we have gone as high as we have done today, and we're sitting around 81% higher than the median at present.
Yeah, it's quite a startling number, and I just want to quickly go through a couple of the charts that I'll go through a couple of numbers that I can see. So you've mentioned the S&P 500 7,500. As we said, it's the 14th of May. We've got the Nasdaq at 29,570. We've got the Dow Jones now back over 50,000. And then just quickly heading over to South Korea, obviously a big semiconductor market. I know that Samsung and SK Hynix are the big players there. But even that is just under 8,000. So it, I just wanted to put a bit of meat on the bones there. But Tom, looking at this chart, what I find very interesting, uh, and again, just looking at about 2017, where we can see that it's sort of a bit up and down, and then we go up, then we dip down a bit, then we're up again. It's a bit wavy. Then we dip below. We come out of the death zone. I'm doing my best for audio listeners here. If you can't see the chart, we sort of dip then out of the death zone, but it's a very quick turnaround. We're back in the death zone, and we've been there for a while. That's completely different from the other two patterns, as you say. The peak to 2000 is pretty much a straight line up, a bit of a dip there, but nothing major. And then 1961, it sort of just, yeah, puts his head up above the parapet and then it's straight back down again. But here it looks like it's been way more sustained. Um, I know we can talk AI, but do you think there's any other reasons why that is, or it is just AI and kicking the can down the road financially as long as we can?
I think it's, I mean, obviously there's a lot of kind of investor irrational exuberance that's come into the market. I think there are two things really that are more evident in this cycle. And one of them is there is this belief that policymakers are always going to step in and help the market out, whatever happens.
Mhm.
Because I don't think every time the market's had issues going back to 2009, there's always been, the Fed's lowered rates or the government's come out and spent money or, kind of something's happened left field, which has helped the market. And I do think there is this view that external, something will always save the market. So I think there's that, but there's also, I think the longer this goes on, it's worth noting there are a lot of traders now that haven't actually experienced a downturn in the market and a recession. Because I mean, COVID-19 obviously wasn't a proper recession from the point of view that it was triggered by lockdowns. It wasn't triggered by a collapse of the market or a financial system like 2008 was or 2000. So I think the longer I think the longer this has gone on, the less people actually, people are happy to take on risk because they don't understand what the ramifications are when it all goes wrong, really.
So we were speaking about this off air, and again, if you have price targets, great. If you don't worry. I'm not going to put you on the spot. But we were talking off air and saying that it's easy to sit on the other side of the fence and go, all the data out there, it doesn't make sense. The house's cards have got to come falling down. I've been saying that for about 5 years, but even I, in the last couple of weeks, have said, well, hang on a minute. If everyone's thinking that, I mean, I don't have a price target, but certainly in the S&P's case, 7,500 is already ludicrous. But 8,000 could be a piece of cake. 9,000 could, might not be out of the question. How high do you think the S&P 500 could go before things take a turn for the worse?
I think to be honest, I mean on this chart, I mean this chart kind of gives a little bit of impact into what it might be because the 2000 .com high was 7,800. So I think if the S&P got to around those levels, it would be kind of forming a double top with the .com highs.
Mhm.
Now it's worth noting again, this is a quarterly average price, so I think we could see prices potentially get up as high as 8,000 because obviously averaging the quarter at 7,800 would mean you'd probably have to have prices go a little bit higher on, weekly, daily basis within the quarter. But I sort of think 8,000 will be, I think the S&P could potentially go as high as 8,000, but I think at that stage, the question is, will we get another catalyst to push it higher, really? And I think, oil continues to trade, around $100. I mean, that it hasn't come down, and I think there are risks because there's a lot of stockpiles being used up across many economies, and if we do find this oil shock continues for much longer, I think these oil prices could be pushing up towards sort of 130, 140, potentially $150 a barrel, which is kind of being controlled at the moment a bit by the fact that we have got buffers in place. The global economy has to deal with this shock temporarily. But I think that that could put a lot of upward pressure on yields because obviously yields are a function of what inflation does. And if we have higher inflation, that could potentially push yields higher, which could put a lot of pressure on the market. Because remember, the US economy has got so much debt, and consumers and businesses have that we can't really handle higher interest rates without there being potentially a lot of issues in the economy. So I think for me, higher interest rates are the big risk here, which could derail this bull market. And it's also worth noting the US government's always happy to sort of come out and increase the national debt and run deficits, but there is something in the bond market called a term premium, and I think a lot of investors potentially might want a greater interest rate for the extra risk they might be taking on because of debt levels continuing to balloon. And the term premium at the moment in the bond market is sitting around 70 basis points, and historically it's sat around 160 basis points. So if we see a 1% rise, more or less, in the term premium, that would equate to long-term bonds potentially rising, the 10-year treasury rising from around 4.5 to 5.5%, which would potentially deal quite a significant blow to, mortgage rates, to business rates. All those will go up because obviously the government borrowing costs do dictate what other borrowing costs do in the economy as well.
Yes, interest rates would be quite a hot topic, I think, moving forwards. I know there's quite a bipartisan vote for Kevin Walsh the other day. I'll comment on that in the market wrap at the weekend. Tom, is there anything else? Again, I know you've highlighted that looking at this chart again, that medium 3,750. To me, this looks like as and when this thing breaks, and let's just assume that it has to break, what goes up must come down, and so forth. Uh, just remind me of that percentage because the percentage drop from possible highs is quite significant.
45% to get back to the median, but that's obviously based on 6,800, which was the last quarter. That from 7,500, I think that's well, it's around 50% to the median from 7,500. So it's anything between 45 and 50% right now, I would say. It's between those two levels. But it's worth bearing in mind, obviously in 2008 we were down around 3,000 points. In the late 70s we were down below 2,000, and then in the late 40s we were down near 2,000 again. So it could well go further down than that. That's just to the median, sort of 45 to 50%, which puts us in line with what we saw in the dot-com bubble when we lost around 50% as well.
One last point that I can see, and again, let me make this point, and then feel free to wrap up after that. Is looking at the peak in 1961 and looking at that peak in 2000, the drop-offs afterwards are very quick. They are very fast. They're not staggered at all. When it drops, it will drop. So I would imagine, as a guess, that whatever point, whether it's 2026 or 2027, whatever it might be, that when it drops off, that's gonna be quite quick, basically, and that might take a lot of people by surprise.
Yeah, 100%, completely. I mean, that's a very good point that I didn't spot in the chart actually, just how quickly they go down. Because I mean, you're talking about potentially 1 to 2 years, and you could be
Mm.
losing easily sort of 45 to 50% in that time. So I think, I mean, it's interesting because there's always a balance because if if you can ride these bull markets, you can make very quick money. But if you are the last person holding the bag when it falls, you can find all your gains just erode within seconds almost, because these things really do collapse fast. So I
Uh,
think, I mean, as we've seen, Warren Buffett's sitting in a lot of cash, that a lot of investors are de-risking. Obviously, Michael Berry also is de-risking significantly. Um, but I mean that's really the thing, really. It's tossing up. Okay, I can make quick gains now because it's a bull market and it's a potentially a bubble. These are when the quickest gains are made. But if I overstay my welcome, I could find that I'm underwater very quickly. So it's just tossing that up, really. And obviously, there's no financial advice here, and everyone's different and has got different sort of risk tolerances. But that's really the way I see it.
Well, plenty to look out for. Tom, just before we wrap up, I'd like you to give a shout out to your LinkedIn. And I forgot to mention this at the start because I will link to this as well. Because obviously your Substack work is fantastic, but you are a bit more prominent on LinkedIn. So if you can, I'll link to this in the notes, but just tell people how they can find you on LinkedIn.
Yes, so just type my name. So I'm Tom Bradshaw, MSc. So you can find me there. And basically, I post 2 to 3 times a week on different sort of macro market trends that I'm seeing. And basically, it gives you a sort of a summary of what I'm going to post on Substack on my Substack newsletter subsequently to that. So it's quite a good way of getting kind of in touch with my work and seeing things a little bit more summarized, a bit more sort of a bit more notey before you go onto Substack and read my fuller analysis and predictions for what's likely to follow.
Yeah, fantastic. Well, again, I will link to that and I highly recommend people check you out on there, especially when you post about Bitcoin, because that always seems to spark a big debate on your LinkedIn there, Tom. But fantastic chart as per usual. I look forward to catching up with you in a couple of weeks for the end of month macro.
Thanks very much, Rob.